So this question says, comment on any ethical and professional issues on increasing the firm's revenue suggestion. So here's a revenue suggestion: that audit partners and managers can be encouraged to sell non-audit services to audit clients by including this in their remuneration package, a bonus for the more sales they make, the more money they make. So selling non-audit services to audit clients. So remember, in terms of ethical issues, we need to identify the issue, then we need to evaluate its significance, and then we can see if we can reduce it or not, reduce the threat or not. So the identification here, the sale of non-audit services, would be a self-interest threat. The more you sell, the more money you make, you don't want to upset the client, etc. So its significance basically means, well, how much of a bonus or how much of the wages is your bonus, the seniority of the people involved, so the seniority of those involved, also the promotion, does that depend on it? Okay, so looking at this, audit partners. So if it was an audit partner, well, I think so senior that therefore any reduction would be for a partner. Could you reduce it? No, not to an acceptable level. They're too involved. Okay, but if it was a manager, because it does mention managers here as well, well, a manager's not quite as high, is he? Not quite as senior. There's no mention of the promotion being dependent upon it. It doesn't say how much of their remuneration. So if it was management, it might be okay, depending on how much, etc. But what you would have to do is review their work. Make sure that the self-interest threat isn't getting out of hand, and review their work. That's basically that then. Next one. All audit managers should suggest to their audit clients that as well as providing the external audit, maybe we can provide internal audit as well. And I'm hoping that in terms of identification then, doing the internal audit and the external audit is obviously a self-review threat, because you'll be looking and reviewing your own work, and even if you're reviewing it well, you'd probably lose some professional skepticism because you think it would all be okay. The significance of this threat then, how could it be less significant? Well, is it performed by the same team? Are the same people doing it? That's one thing. How much of the internal audit? How much reliance is the external audit placing on the internal audit? All these things will show how significant it is. So that would be okay if it's a separate team. So one team doing the internal audit, one team doing the external audit. How much of the internal audit? Well, got to be careful here. You've got to make sure you have no management responsibility. Because if you show that you've got a management responsibility, then that's it. The game is over. You cannot be an auditor and also be the manager. So safeguards then, if we're going to get rid of this, we're going to think of things to reduce it. Management must take responsibility for internal audit, even if we're performing it. So they've got to take full responsibility. Management must review and assess the work. They're in charge, not us. Management must evaluate any recommendations. And if all those are in place and it was a separate team, then maybe we could go ahead. If the internal audit work, though, was a lot on financial reporting, then you couldn't do it if you're a PLC. If you're a PLC, you can't do the company's accounts, etc. So if the internal audit work was a lot on FR, then you couldn't do it. But if it's not a PLC and we're saying we could do it, then you need to make it clear. We need to have a separate engagement letter. We need to have separate fees. It needs to be pre-approved by those charged with governance. All right, they're the issues that you need to be aware of. Hope it helped.